Hello, people. This is Dr. Wang here recording. We are coming to the end of the semester, and here is our last chapter, chapter 18. It is about initial public offering. And I set up a separate module on the Canvas, and just because it is quite different from all the other chapters. I hope that you have already taken a look at the CNBC video. It is another YouTube video produced by the CNBC channel, and it shows you a very good idea about the definition of IPO and what's going on with an IPO. And I want you guys to first take a look at this video before we can move on to the lectures. All right, assume 5 minutes have passed after you watch the video. So what is the IPO? IPO stands for Initial Public Offering, and this is the major vehicle for a corporation to raise cash from the capital market. And also it offers a good opportunity for the founders to become rich and harvest for their wealth. And when the enterprise became IPO, become publicly available to trade, then it become easier for them to issue more equities or even more debt in the later stages. Just because their name was already there, they are popular, they are well known, so people would like to buy more of their stocks if they are operating regularly. So the security market could be divided into the primary market and the secondary market. We are talking about the equity security market. So essentially that's about stocks. The primary market involves the issuer, which is the company, and a few buyers. These buyers are the first buyers of the company's equity. And then the first buyers purchase the stock, then they will resell the shares to other buyers, and that is basically the secondary market. Okay, so when the existing owners sell to another party, then that's the second market activities. So we have two major stock markets. We used to have three, but the American exchange got merged with the New York Stock Exchange. So right now, only New York Stock Exchange and the NASDAQ are the two prevailing stock markets in the country. And the New York Stock Exchange is much larger in terms of market value, but NASDAQ, they have more stocks. You can see that most of the NASDAQ stocks are small stocks, high-tech stocks, and many of the stocks are junk stocks. All right. And who are the agencies regulating this securities market? So definitely you want to remember SEC, the Securities Exchange Commission. They regulate initial public offerings, trading by corporate insiders. I'm talking about the legal trading by corporate insiders with public disclosure of their position, of course, and corporate proxy processes, and also the national stock exchanges. And the Federal Reserve Board, which is the central bank of this country, controls margin requirements. The margin requirements basically regulate how much you can borrow to buy the stocks. With some brokers, you can borrow up to half of your investment, or some brokers would borrow with more, depending on the time. And I think right now, if you want to trade the stocks on margin, it should be the 50% margin requirement. That means you can use the $50 of your own money and you borrow another $50 from the broker, then you can buy $100 worth of a stock. All right, and also the states control the issuance of securities within their boundaries. So we have the local government control their own companies within their border. And we also have the National Association of Securities Dealers take actions to ensure the integrity and credibility of the trading system. So if any suspicious activities get discovered, they will report to the SEC, and they may also report to the FBI if insider trading has happened. So it is pretty important for the security market to be tightly regulated. Otherwise, it will become a unfair game, and people with a large amount of money would exploit the system, try to rip off the people with a small amount of investment. And what are the regulations about? Mainly about manipulations and insider tradings. So these are the two major ways to unfairly gain advantage in stock trading. And from the firm standpoint, if you are a founder of a company and your company is running well and it grows large, so you should attract venture capital first before you go for initial public offering. Well, when we're talking about initial public offering, it is a quite big picture here. You should have some people help you before the IPO is on the table. So these people who would help you would be called the venture capitalist. And these are institutional investors, and they would buy large amount of your shares, and they also can share of their expertise, their resources to help the business grow. In the first report of this course, we learned about the Planet Popcorn, a company in California, and there was a venture capitalist from Chicago, and he could basically offer a lot of resources like the logo designing, like the website designing, and so on. Okay, you can also raise money in a private placement to this venture capitalist, and this is more like in a private channel. And when you think it's mature to get much larger scale, then you go for public. All right, and in a public offering, you can offer to the public, but you have to get registered and you have to put yourself on the map, on the radar all the time. Um, and for the privately placed stock, it should not be. It doesn't need to be registered, but it must be a credit. So here is some files you need to complete. You need to send out an offering memorandum within 20 to 30 pages of data information, and it should be prepared by the securities lawyers. And the buyers certify that they meet the net worth requirements. Usually, it is a $1 million net worth requirement to be qualified as an investor for these privately placed stocks. And it is true that the privately placed stocks have a higher earning on average than the public stocks like Walmart or Apple. So the private ones actually makes more money, and it is also harder to invest in them. You have to be qualified to be an investor. And definitely there are some advantages for going public for the company. For example, the current stockholders can diversify. They don't need to hold all the stock shares just as some stocks. They can cash them out. They can diversify their wealth from stocks to cash. And they can also, in the company stocks, since it's become publicly traded, it's easier to buy and sell, so the liquidity increased. It is also easy to raise capital in the future once the public has been, once the IPO has been finished and once the name is well known. And the public status also established the firm value, and it becomes easier for the firm to motivate their employees by giving them stocks or options attached to the stocks. Of course, going public is not easy. You have to comply with all these regulations. You must file numerous reports on a quarterly basis, on an annual basis, and you must disclose your operating data. And sometimes you will feel discomfort about that kind of disclosure. You don't want your competitor to see that, but you have no other ways to avoid it. That's the game of going public. And also for the major shareholders and also the managers and the officers, they must disclose their stock holdings. If they sell their shares, they should let the public know. so your personal wealth is kind of exposed to the public knowledge. Okay, and special deals to insiders must be difficult to undertake because you need to have the consensus of the shareholders as a group or the board of directors. Once the firm goes public, it's very hard for you, even you are the owner or the original owner or the founder of the company, to make special deals because you are under the governance of all the stockholders. And a small new issue may not be actively treated. Sometimes that's true. When the firm gets public, they only issue like 5% of their total equity, and the rest 95% is still untouched. So the issued shares may not be a better reflection of the true value of the stocks. Okay, and also you definitely need a good PR, public relationship, to manage the investor relations, not just to disclose your financials, but also to answer all kind of questions from the investors. Okay, so what are the steps of an IPO? You need to have a investment banker or a group of investment bankers. We call the group syndicate to be the underwriter of the security of the stocks. And in the previous chapters, we know I have discussed the role of underwriter. So these are the middlemen between the company and the public investors. And they definitely charge a fee for that. And we call that flotation fee, flotation cost. After you find the investment banker as the middleman, and you will file the registration document. It's called an IPO prospectus or the S-1 form with the SEC. And your report 3 of this course, which is 5 points of your grade, I believe, is to analyze the S-1 form of a Facebook when it got public. All right, there are a lot of pieces of information here in the S-1 form, like the major shareholders, the owners, the financial statements in the past years, who are the major underwriters, what will be the offering price, what date is the offering, and what is the commission fee charged by the underwriters, investment banks, of course. Okay, so once you file this S-1 form with the SEC, you will choose a price range for preliminary. Okay, so the price range doesn't have to be a fixed number. You want to have some room for negotiation, and then you go on a roadshow. A roadshow, well, from its name you can see you go around the country, go to different states looking for the big institutional potential buyers to try to sell your stocks hard for them, and you are doing the primary stock market. Okay, this is not secondary, it's the primary. It is between you, the company, and the major first buyers. Okay, and you will need them to subscribe your shares, and to book your shares you need to maintain the booking, you need to build the book, and you hope that the buyers would oversubscribe your shares so you can sell at a higher price. And then you're going to set the final offering price in the final prospectus. So what are the criteria important when you are choosing an investment banker? If you want to choose an investment banker, you want them to be good. So you want them to have a good reputation on the Wall Street, and they should have dozens of years experience, if not hundreds of years experience. The best one, I think, is Goldman Sachs. They have done a lot of such a thing, and their history is like 150 years already. And you could then the investment bank should have connections to the investors, either institutional investors or retail individual investors. And these individual investors are not like you and me, the regular salary people. These would be the NBA stars or the Hollywood stars with a lot of money, or just the CEOs of famous companies. These kind of individuals we're talking about here. Okay. And you also prefer some support in the post-IPO secondary market. So once the stocks are sold, are became publicly available to trade, you want it to have a good reputation, so the stock price do not go down that easily. So you want to have some analyst covering the stock to um, to disclose all the information about the company, better the positive ones, to maintain a good reputation, so the stock price does not go down that easily. All right. So how should a IPO price be determined? Well, this is a chapter 11 basically. You need to calculate the free cash flow based on the firm's operations, and you definitely need to look at the firm's financials and extract all the information like net income, capital expenditure, the inventory changes, and so on. So I'm not going to cover again this free cash flow valuation model. I'm just saying that what we learned before really plays a role in the real world. And some other variables you need to consider would be the price to earnings ratio, price to cash flow ratio, price to sale ratio, and so on. So this is our chapter 3 of the financial ratio chapter. I hope you don't forget that. And here are some more description about the roadshow. You can take a look at it. All right, and here's some description about the book building process. Okay, here's something interesting. When a firm goes IPO, most likely the price will go up. Actually, over the past 40 years or so, 75% of the IPOs have the first day price goes up. Okay, their first day return is positive, and on average, that's first day return is 16.8%, and that's huge. All right, so you definitely want to be the very first buyer of an IPO because you can earn nearly 17% return in one single day. While the first day return is pretty high on average for the IPOs, the companies don't get this huge return. For example, in the first day, the stock price started with the offering price, let's say $100. That's what the company gets from issuing the stock. And then by the end of the first day, the price jumped to $117, which is 17% return increase. Who harvest this 17% return? It is the first buyers of the company, but not the company itself. So that creates some conflict of interest. When the first day return is high, that makes the customers, the brokerage customers who are connected to the investment bankers, they are happy. All right. And also, when the first day return is so high, think about this. If the price should be this high, but the offering price only at right here, then that means the offering price is too low. And when the offering price is too low, it makes it easier to sell the shares, to sell the issue. And definitely the company would like the price to be as high as possible. So they also have some ways to make it up. For example, the original owners from where the securities are sold, they only sell a small part of it and reserve most part of the shares. So when the stock price increase in the first day or in the first month, then their remaining stock value would increase as well accordingly. And when the stock price increases high, and the general public will view this stock as a good investment opportunity, and that's gonna make later offerings easier. So if the company wants to sell more shares in later stages, it will be easier because it has a good performance history. Well, in response to the high first day return, in the long run, okay, let's say in a 2-year or 3-year, 5-year horizon, the IPO stocks do not have a good performance as the non-IPO firms. All right, and this is a fact. I have done tons of research on this part, and the IPO underperformance is actually a very big issue in the world of finance. And who are the underwriters? As I said, those are investment banks, and they take care of the security underwriting process, and they charge 7% underwriting fee as commission. And this is the fee charged in percentage or the flotation cost, as we mentioned in a previous chapter. There are also direct costs paid to the lawyers, to the security printers, accountants, and it can go as high as 400,000. Actually, on the canvas, you have to finish a report in this module. It is about the IPO of Facebook. Let me just click here. Internet is going slow. There are 3 documents listed in the report. The first is a Word document. It is the questions you need to answer for this report. So you can see that it is about Facebook IPO, and it is asking you what is the date of the IPO, how many shares are issued, who are the underwriters, and who are the top owners. And it also asks you about the financial statements, like the total assets, total liabilities. It also asks you about the stock performance of the first week of the IPO and the overall performance from the IPO till today. All right, so you need to do some research. For example, in the last question, you probably need to check Yahoo Finance, all right, to get the stock price. The offering price of a Facebook at the IPO was $38. Right now, it is much over $100. Okay, and the second document is the S1 form, the IPO prospectus. You're gonna check it. So right here is the file. It has 212 pages, but you don't have to go through all of them. You just need to extract the useful information here. So this is the company's name, and here is the number of shares outstanding. And you will also see the offering price here, the underwriting commission for each share, all right? So that's how much money the underwriters made for each share issued. And this is how much money left for the Facebook company. And here are the syndicate of the underwriters. You have Morgan Stanley, JP Morgan, and Goldman Sachs. Okay, and if you want to get to know the owner's information, you can use some investigation skills. Just hit Control F to find the useful information. For example, you type in the keyword owner, and you just do some search until you find the list of the owners. It is somewhere in there, I'm sure of that, but it shouldn't take too long. Okay, so right here are the names of the owners. So Mark Zuckerberg definitely is on the top of the list. And Sheryl Sandberg, David Eberspan, these are famous private placement investors. These people were the angels of a Facebook at the infancy of the company, or the venture capitalist. All right, so based on this page, you can tell the shares of each investor or each owner. And you also will see this Class A shares and Class B shares. And this comes to the concept of a dual class structure. The dual class structure basically means for the same stock shares, they have the same cash flow rights, same dividends, but of Class A, each share would contain 10 voting rights, whereas the Class B, each share would only contain 1 vote. Okay, so here is a major difference. Class A is more concentrated in voting power, whereas Class B is not. And I have also pasted another document here, which is an article about the Facebook dual class structure. It basically discussed the pros and the cons of a dual class in the case of a Facebook. And you are going to read this article and answer the questions regarding to the dual structure share, dual class structure of Facebook. All right. And it also asks you about the financial statements. Well, you know the financial statement is made of balance sheet, income statement, and statement of cash flow. So you can just type in a balance sheet as the keyword to search. And here's your balance sheet. You can see current assets, current liabilities, total liabilities, and total equity. So you can grab some information from this search and answer the questions. And here are the 3 different years before the IPO, and all the financial statements in those years are available.